welcome to Legalese. I'm attorney Christopher Lilly. I'm your host. Today I am joined by attorney Robert Markley here to my right. Robert has an office in Littleton, Massachusetts. Robert's going to talk with us today about the real estate closing market. That's the title of the show. Developments in the real estate closing market that's been brought on by changes in the real estate Settlement Practices Act, which has come into effect, we want to say 2015, 2016?
October, yes, 2015.
And it's something that has changed quite a bit what happens in the real estate closings that people undergo when they're borrowing from financial institutions, etc. And Robert, what was enacted?
Well, there were some changes that were put into effect in the existing law. So in my opinion, the most significant were the integration of the former settlement statement and truth in lending statement into the closing disclosure. Okay. And then the 3-day requirement to disclose the final numbers 3 business days. No, sorry, strike that, 3 days before the actual closing itself. Okay. Whereas before 2015, there was actually no requirement for the bank to tell the borrower what the final numbers were until the closing itself, unless the borrower specifically requested those figures, and then they only had to be provided 24 hours before the closing.
If you're lucky.
Right. Yes.
And so now these were some changes that have been brought on by the recent changes in the law. What brought on the changes in the law? Why do we have these changes?
Well, these were the result of the housing market crash that started back in 2008, 2009. It only took about 10 years to put them into effect. Okay. So essentially, the housing market was brought down. There were a number of factors, but some of the most significant ones were the subprime market, credit being available to everybody, including people that previously hadn't been considered worthy of a loan, either because they didn't make enough money, their credit score was too low, there were recent bankruptcies on their credit report, things like that. Mm-hmm. So once credit became available to all of these people that were considered higher risk for defaults, the loans were then bundled together with loans from with people with 800 credit scores. So what would be considered safe loans were bundled in with the riskier loans, and once the recession started, the subprime loans started defaulting and basically infected the entire pool of mortgages, including what would be considered low-risk loans. And so that, along with the recession, basically caused or were significant contributing factors to the housing market crash.
And so how is it that Congress had determined that this is the appropriate response to that crash?
Well, Congress, in their infinite wisdom, decided that one of the reasons that there were a number of reasons that went into it, but apparently Congress decided that things were too confusing to borrowers, and they were taken advantage of by predatory lenders who would offer products that were not actually in the borrower's best interests, or were offering loans to people that otherwise wouldn't have been able to get the credit. Okay,
all right, and so there were previously, in effect, ways of disclosing truth in lending statements, that sort of thing, to the borrower, what they're actually engaging in.
Yes.
And now they're saying that that wasn't sufficient?
Well, Congress decided those forms were too confusing. So what they decided to do was to integrate the truth in lending statement, which was designed to show you what the cost of the loan was over the term. So basically, what the principal balance was, the interest that you would pay if you went for the entire term of the loan, and then what the total amount of money that would be over the 30 years or 20 years or 15, whatever the loan term was. That was combined with the settlement statement that contained all of the final numbers, as far as closing costs, settlement charges, escrow accounts, title insurance, things of that nature. So what was done was those two forms were integrated into what is called the closing disclosure.
All right.
Which I think is actually more confusing to people because it reads like a tax return. So essentially the first page of the closing disclosure has the very basics of the new loan: the principal, the interest rate, the term, what the monthly principal and interest is, any escrow, whether it be home insurance, property taxes, PMI if you have like an FHA loan or something like that, and then what the total settlement charges are. And then the final line is the cash due or cash out, depending on what your final numbers are.
Okay.
The second page, that is similar to the old settlement statement. So the prior to the changes, the settlement statement was a legal size page that had two sides to it. On the first page, second page had one long list of all of the charges. So what the new closing disclosure does, it breaks the second page into halves horizontally.
Basically the second page of the HUD we're talking
Correct.
about.
So it's divided horizontally. The top half are the closing costs. So that would be points, any kind of origination fees, title insurance, credit reports, flood certification, things of that nature. So those are the closing costs. Those are things that you're only paying because you're doing the loan.
Okay.
And on a refinance, you're only paying them. If it weren't for the refinance, you wouldn't actually pay those. So those are considered the closing costs. The bottom half of the page has the rest of the settlement charges. Escrow, interest on the new loan, recording fees, things like that. So those, like the interest, the property taxes, those are all things that you'd have to pay anyways. So they're not considered closing costs. And I think that's what confuses people on the new loan, is that a lot of times loan officers will generalize and just say the settlement costs or the settlement charges.
Right.
And the average borrower, layperson, doesn't understand that that final number is actually comprised of two different things: the closing costs and settlement charges. So a lot of times they're lumped in together, and I've done closings where there'll be $1,500 due from the borrower, something like that, and they were told that there are no closing costs, and so now they're confused. And when I look at the closing disclosure, there aren't any closing costs because there's a lender credit to offset that top half of the page. But the bottom half of the page, the non-closing costs, the just general settlement charges, those are it's accurate that there are no closing costs, but that doesn't mean there isn't any cash due, because you still have to pay the property tax, you still have to pay the home insurance. So that's why I think it can actually be a little more confusing to people than it used to be. But like I said, in Congress's infinite wisdom, they decided that this was the best way to do it. But let me also add that for anybody that is going to do a home loan, there's also what's called the ALTA form, the American Land Title Association form. And that is a much easier way to understand what the costs are, because that is just two columns. You have credits and you have debits, so it's more like a check register. It's easier to go through. So on the ALTA form, it'll show on the right-hand side the credits, so what the new loan amount is and any lender credits. And on the left column, they're side by side, will be all the settlement charges, closing costs and escrow and things like that. And at the bottom of the page will show what the final numbers are. So I think that's a little bit easier. There's no requirement for the bank to disclose the ALTA form, only the closing disclosure. So I'd always recommend to people to ask to see a copy of the ALTA form.
So there's an ALTA form that's created by the bank, but that's not necessarily provided at the closing.
No, it's provided at the closing, but there's no requirement to disclose it ahead of time.
Ah, gotcha. Okay. So now it seems like all of the remediation that's addressed in the new law is dealing with that front end cost question, which is what do you have to pay up front? How is that addressing the crash?
Well, some people say that it's not, or it's not sufficient enough, and that it's just setting us up for another crash. There are a couple of safeguards that were put into place, though, one of which is the requirement that the closing disclosure be sent the 3 days before the closing.
So let's talk about that,
Yes.
the 3 days that's required before the closing. And you referenced that previously you'd get all of your documents on the closing day. It's a big rush. Everybody's exchanging their documents, and there's a big push on for you to do this quickly, so that, and nobody knows what they have until they get that closing packet at the end, right?
Yes.
So now we're trying to give them the ability to look at what they have.
Correct. So at least this way they'll know what the final numbers are, you know, ahead of the closing, with enough time that if there is some issue with the final numbers, they have a chance to try to have that explained or changed. You know, if they were told by their loan officer they'd be getting $1,000 credit, but it doesn't actually show up on the closing disclosure,
Right.
they'll know it ahead of the closing, and therefore can have that addressed before they start signing documents.
Okay.
Also,
How is that disclosed? Who, the
well, so
closing attorney?
Well, that depends. So,
Okay.
actually, my next point was that one
I'm
of
sorry, go ahead.
no, that's all right. One of the ways that banks have made it easier for borrowers to see forms is most banks now have e-signing, or they have a portal that you go to where, depending on the lender, you know, some lenders will have more documents for you to e-sign than others, but a lot of them will have the note, the mortgage, you know, the closing disclosure, and you'll have to e-sign it, and that way you'll have those. The three central documents are the note, the mortgage, and the closing disclosure.
Right.
And everything else basically revolves around or is ancillary to those. So by doing it this way, it's not just the closing disclosure. The requirement is only for the closing disclosure, but most lenders have now made other forms available to the borrowers before the closing.
Such as the mortgage?
Yes, the note, the mortgage, you know, other documents, maybe the escrow.
Which there was never time to read before.
Correct, and you wouldn't see them until the actual closing itself, which sounds kind of crazy, but that's the way it was. So that's not a requirement of the changes in the Real Estate Settlement Practices Act, but the lenders have taken that step to try to mitigate any issues before the closing even takes place, so that any problems, or, you know, if the borrowers thought they were going to get a 3.5% interest rate, but it turns out to be like 3.75, they'll see that well ahead of time, you know, before the closing even happens, and have a chance to change that. Okay.
So I'm a borrower. I've received my closing disclosure.
Yeah, which is that's normally emailed.
Okay.
Some lenders will overnight it. Some lenders have a portal that you go to and download it or e-sign it. And this is something the borrower should be prepared for if you haven't already done a refinance or a closing, is that anytime, and this is Regulation Z of the Real Estate Settlement Practices Act, that there's a tolerance where if the final, you have to disclose the final numbers ahead of time. The bank will send an estimate that looks like a closing disclosure. It's normally just the first couple pages. But
it may be subject to change?
Correct. If the final numbers change, what Regulation Z says is that they can only, the APR can only increase 1/8 of a point, or 0.125%.
Okay.
And this is where it can get a little confusing. So that change is only related to the closing costs. It doesn't include taxes or insurance, because sometimes what will happen is the bank will put together the closing disclosure. The settlement agent will confirm with the town whether or not taxes have been paid, and those taxes can be added to the closing disclosure if the bank didn't already include them. that is not considered a violation of RESPA because, as I had said earlier, the taxes are something you have to pay anyways.
Right.
So it's not an additional closing cost. However, if the numbers in the top half of the second page change, origination fees, title insurance for the lender, if those change more than 0.125%, that triggers a new 3-day disclosure of the closing disclosure.
So the
It prevents banks from sneaking charges in
Right.
at the closing that they hadn't previously told the borrowers
but
about.
the term tolerance that you use deals with the extent to which a change would still be permissible.
Correct. Without a new 3-day disclosure.
Okay, let's talk about that in just a second. There are certain things that have a tolerance, certain things that don't require a tolerance, certain things that you just can't change, right?
Correct.
And how does that break down?
So the things that can change are the bottom half of the second page, the non-closing costs, the home insurance, the real estate taxes. There are a very, very limited number of charges that can change without triggering a new 3-day disclosure period.
Okay.
So the reason that there's that tolerance is that it gives the bank a little bit of a breathing room, I suppose. So if they had originally calculated the lender's title insurance policy, because that's based on a portion of the loan, if they, let's say the borrower had initially wanted to take $150,000 and then later they'd already submitted their application, now they want to change it to $175,000, that'll increase the cost of the lender's title insurance. But
that's on the borrower. That's the borrower's decision.
Right, but it still triggers a new disclosure.
So that new disclosure or let's say the first disclosure having come to me as the borrower, I decide there's something on there that I want to change. Does that mean that it has to then undergo another 3 days?
Depending on what the requested change is. So the top part of the closing disclosure, and this will take me into some of the minutia.
Oh, sorry.
Right, no, that's okay. So the bank, they basically have closed lists now for they work with a very limited number of settlement agents, whether that's the title company or in Massachusetts the law firm that closes. So that top part of the second page of the closing disclosure, the closing costs, those are generally fixed costs that they're going to be the same, and the borrower cannot request the borrower can't request changes or to use their own agent for most of those. So you can hire your own attorney if you want. That has to be paid separately. You can request, some banks will allow you to request a certain attorney's office be the settlement agent. And if that is the case, then that number can change because the borrower specifically requested that specific firm to do it. But for the most part, the top half of that second page, the closing costs, are those companies. For instance, a lot of lenders use like Credco for the credit agencies. For the flood certification, they use CoreLogic. Those are fixed. Those can't change because the borrower is not allowed to request which company does that. They're basically told by the lender, this is who we use, and because the borrower has no input, those are the figures that are subject to Regulation Z.
Okay. All right.
If that makes sense.
If I decide, well, let's say I want to make a change as the borrower, 3 days, an additional 3 days has to be tacked on. Does that push off the closing?
So generally not, because when it comes to the things that the borrower can request, those are going to be on this bottom half. Those are the considered non-closing costs. They're costs of the loan, but they're non-closing costs.
Right.
So if the borrower specifically makes a request for a change, then that's not going to implicate Regulation Z. Regulation Z is designed to protect borrowers from fees over which they have no control.
Okay.
So that is why those figures if they change, cannot result in more than a 0.125% increase in the APR, because the borrower has no control over what those fees are.
And if they do change, then you have the 3 days.
Correct.
Which may push off a closing.
Correct. Which is why I always tell people, don't buy and sell a house on the same day anymore.
Okay.
Because if there's some issue with the purchase, the bank can't go through with it. It's a federal law that there has to be a new 3-day disclosure. So if you sell a house in the morning and you go to buy your house, a new house in the afternoon, and there's some issue with your purchase, you're not going to have a place to live. Because the bank can't do that purchase that day. There has to be a new 3-day disclosure of the final number. So you're going to have to go back 3 days later to do your purchase.
Can the borrower waive that 3 days?
No.
It's for their benefit. They can't waive it.
Correct.
Okay.
Because the government knows what's best for you.
Thank you. So, all right. Let's bring up what happens typically. You have adjustments at closing. Where
with
you
purchases, yes.
With purchases.
Correct.
Right, thank you. Fuel adjustments, taxes you mentioned already, repairs, that sort of thing.
Yes.
How do those factor in?
So that doesn't actually factor into the changes or Regulation Z, because those are not considered closing costs. That doesn't involve the bank. It doesn't involve any of the bank's charges.
Okay.
So those are handled today the same way that they were handled before 2015. Most settlement agents will have a document that you'll sign that will say that the parties agree to adjust taxes or things like that, or oil or prorations after the closing, in the event that someone's alerted that, oh, there actually has been a change to the taxes, or there is an issue with the oil and there was a miscalculation. So most settlement agents at a purchase will have a document that the buyer and the seller will sign that says that the parties agree to do post-closing adjustments if something comes to light that would result in a change to the oil, or what the utility charges may be.
But that's for something that's found after the closing, right? What about on the last day of the closing? We now have this fuel adjustment. Is that something we should have come up with previously?
Well, it depends on the circumstances. Most of the time, yes, that should be known ahead of the closing. Whenever I do a purchase, I always ask for paid receipts, so I know exactly what the numbers are for the fuel.
And that does have to make its way onto the disclosure, doesn't it?
Yes, that's correct. So normally what will happen is the realtor will usually set up final meter readings. They'll get the smoke certificate. They'll take care of getting the receipts for any repairs that were done. If there's an issue, I always have, if there's repairs that are needed, I have a repair addendum, which is a separate page to the purchase and sale that will list all of the different things that came up during the inspection or walkthrough that would need to be repaired. Then that can be adjusted, well, depending on the walkthrough, right before you go to the registry or to the attorney's office to do the closing on the purchase. So anything like that, if the repairs call for a licensed electrician or a plumber or whatever the case may be, that the paid receipts would be provided before the closing. If you get to the closing and the seller for some reason has refused to provide paid receipts for some of the work, you can still have a holdback. So that hasn't changed.
Can you? Yes. The holdback is still intact?
Oh yes, the holdback is still intact. So that's just prior to 2015. That hasn't changed. That is a way that you deal with some items in the purchase and sale that may not have been completed, but the buyer still wants to go through with the purchase. If the repairs are significant and haven't been done, it would be grounds for the buyer to walk away. If like a roof needed to be repaired and it hadn't been done, that's a significant issue. We're not talking about a screen door that needed to be replaced. But yeah, so the holdback is still an option for work that has not been completed or other issues maybe that have come up. But that doesn't impact the loan amount, your interest rate, your closing costs. That's just between the buyer and the seller.
So has there really been a change in the way we're approaching closings?
Yes, there has, because the underwriting standards have been tightened up.
Okay.
So there's not really a subprime market anymore,
Right.
because they kind of closed the floodgates on Fannie and Freddie loans, which are the bulk of loans in
And
the
that's
country.
on the decision on whether to issue the loan in the first place.
Correct. So I guess basically the best way to put it is that people that are seen as risky or riskier candidates for borrowing money because of the credit score or job history or bankruptcies or things like that, the people that comprised the subprime market prior to 2015 are now no longer able to get loans. Okay. Or a lot of them will go through try to go through the FHA now instead of doing a conventional mortgage. But the underwriting standards have been tightened up, which is why if you've done a refinance since 2015, or if you're planning on doing one now, it's a lot more hoops to jump through, which is a good thing in my opinion, because if we had these rules, especially the underwriting rules and the 3-day disclosure rule in place prior to 2008, we probably wouldn't have had the housing crisis that we did.
Right, right. Well, Robert, I want to thank you for coming here and talking to us about some of these changes, some that would be determined to be recent, but maybe not so much. We're talking about back in 2015, but that's when it went into effect. But I guess it's undergone some adjustment since being implemented, and I appreciate you bringing your expertise to the table here and telling us what to expect at our residential real estate or otherwise closings. Ladies and gentlemen, I want to thank you for your attention here. As I've said before, Legalese is a television program of legal information. Nothing that's being said here should be taken as advice on your particular cases. If you have questions, about the documents that you're looking at, the legal documents, if you have questions on any matter of legal importance, I would ask that you talk to local attorneys such as Robert Markley here in Littleton. And that's what your local counsel is there for, is to help you through some of these processes. Robert, thank you once again.
My pleasure.
I'm attorney Christopher Lilly with attorney Robert Markley. Thank you and good night.